All right, warm welcome everybody. It's Friday the 14th of June 2024. Now, I want to start this session with a quick review of what exactly happened to the US dollar yesterday, because we had a pretty weird reaction to data, which was, in my opinion, very, very bad. I mean, looking at the PPI, as well as the initial claims data, the dollar's reaction that we had yesterday didn't really make a lot of sense on the back of the data that we had. What are we talking about? If we quickly take a look at the calendar, we can see here that we had a massive miss across the board for the US data yesterday. Initial jobless claims printed at 242. We'll look at a chart of that in a second. Continued jobless claims came in above the market's maximum expectation. That was bad. PPI year over year came in below the market's minimum expectation, in line with 2.2. That was a very significant miss, right? Remember, going back to the preview that we did, we know that at 2.2, it would have shown no acceleration when the markets was expecting inflation to go to 2.5. That was a big miss. Same story for the PPI month over month. We expected anything at 0 or below to be a significant miss. And what did we get? Well, we got negative 0.2, much bigger than expected miss. For the year-over-year core, we printed at 2.3. Now, again, looking at 2.3, we knew that wasn't going to be a massive miss, but it was below estimates and below the prior print. That would have been good enough. And in terms of the core, we were looking for a number like 0.2 or lower. And obviously there we got 0.0. It was a massive miss across the board. Now, what we would have expected to see on the back of a print like that is dollar downside, yield downside, ES upside, and gold upside. My preferred trade for this was the Kiwi dollar, just like it was with CPI. And we had that first initial nice pop to the upside, and then the dollar just started to reverse that move aggressively with the, across the board. So the question is, why didn't the dollar react negatively when we expected it to on the back of data which was convincingly negative? You can't look at that data and say, oh yeah, it was just, it's just marginal data points. That was a very big miss in terms of market expectations. It was what we would have called the ideal dovish scenario. So why didn't the dollar go down? I think the most likely reason is that the dollar caught a little bit of a bit from a risk sentiment point of view, caught in risk sentiment crossfire, if you will, because yesterday saw yet another massive ballooning in risk premiums across Europe. I mean, if you take a look at the BTB Bund spread, not a massive pop yesterday by itself, but we moved back up towards that 1.5 level. And take a look at where we are trading now. If we just quickly hide the French number and the currency index, take a look at this. We are now right back at that 1.57 level, key significant level here for the BTB Bund spread. If we isolate that and just look at the French one, I mean, this is a scary chart, guys. Look at that French and Bund spread currently at 0.70. Massive upside. That is just showing you the size of the risk premium buildup here across European markets. And I think that was the better trigger, the better reason for why the dollar stayed bid, despite the data coming in massively low. So I think it was really just down to risk sentiment flows. I mean, we had European equities really wetting the bed yesterday, massive amount of downside for European equities. So it does look like a little bit of a safe haven bid. Especially if you look at how the euro performed, if you look at how EMEA performed. I don't think at all that the reaction we had in the US dollar yesterday, or at least the lack of the reaction we had in the dollar, was at all due to, a hawkish Fed pricing at all. The reason for that is that the other markets doesn't reflect that. If we were expecting this to be a hawkish Fed-inspired reaction in the dollar out of PPI, then we would have anticipated things like yields on the US side to be much higher. Yields didn't go up, yields went down, which again feeds into bids on the bond side from a safe haven point of view, right? That marries up with the movement that we had in the dollar as well, looking at this as more of a risk sentiment flow as opposed to a Fed repricing flow. Again, if this move was associated with the Fed, then yield should have been much higher than we were yesterday. Similar story, US equity should have been much lower if that was the case as well. And we just didn't see that play out. Instead, we saw European equities push lower, and obviously markets favoring the US jurisdiction over Europe, given the political uncertainty. So it all feeds into the political narrative right now, which I think makes the most sense. And also, you know, something that also supports the view that it was more of a risk sentiment flow based off rejection, if you will, of that US data. Let's quickly take a look at what happened to the Swiss franc yesterday. It wasn't just the dollar that caught a solid bid. You know, the Swiss franc was right up there with the US dollar and still is, which again, you know, proves that it was more of a risk sentiment flow yesterday that supported the US dollar. In terms of this data that we got, you know, this is the type of print. This is the type of print that I would trade 9 times out of 10. There are going to be times when the markets just doesn't give us what we want. Doesn't matter how much preparation we do, doesn't matter what prints we get. If we get a session like yesterday where obviously there was a lot of risk premium built up, the markets might react differently than the way that we would like or anticipate, and that's okay. It's going to happen sometimes. It's just good to do that assessment to try and figure out, okay, was there something that we missed? You know, was there something that could have done slightly different? And again, given the exact same opportunity 10 times, I would take this trade 9 times out of 10, you know, based on the data itself, because the data should have mattered more, but I think it didn't matter as much, obviously, given the build-up that we've seen. And these moves are massive, guys, in terms of the bond market. You know, this is not... These moves in the BTB, as well as the French and German 10-year, these are some serious increases here in risk premiums. I'm quite surprised that the euro isn't much lower already. You know, the euro is, to be fair, still trading at the weekly lows, but based on the move in rates markets alone, in those peripheral spreads, I would have expected to see the euro even lower than it is right now. So that's just a quick review for why I think the dollar didn't react the way that I would have expected it to yesterday. But again, you know, I would take that trade 9 times out of 10 again, based on that data that we got.